Hello, this is Joe Hoyle from the University of Richmond, back to talk with you about Chapter 7. But now you have read the chapter on account receivable. When you read this chapter, there were many things that helped you understand the information that was being conveyed by a company. Therefore, when you read it, what did you think were the 5 most important things that you discovered in this chapter? The things that really made a difference in your understanding of both accounting and how accounts receivable is reported. I've made my top 5. Let's compare. If you had any different, then ask yourself, why did you think they were more important when I didn't put them quite as high? Here's number 5. Number 5 for me was the idea of vital signs. We introduced this here in Chapter 7. If you go to a doctor and ask the doctor if you're healthy, the doctor will check your blood pressure, your heart rate, your cholesterol, other kinds of vital signs to see how healthy you are. In a company, people do the same thing. They look at certain things to see whether they believe a company is really financially healthy and has good future prospects. We've looked at these before, the current ratio, working capital, and here we introduce it in more detail. We do this primarily by determining the age of accounts receivable. How long, on the average, does it take the company to collect an account receivable? We take the account receivable and divide it by the sales per day. Companies can monitor this vital sign, and if it gets too old, they can take action to make it better. I wanted you to understand that it's not just the accounting information that's important, but how you take that accounting information and what use you make of it. For me, this was the 5th most important thing in Chapter 7. Going now to number 4, I put the allowance for doubtful accounts because this was an account that we had not looked at previously. This is an account that actually reduces an asset. We sometimes refer to this as a contra account because it always goes with another account but as a reduction. When you have accounts receivable, you know that some of them will not be collected. How do you take that into account? You do not know which ones will not be collected, so you cannot take them off the books yet. So how do you make a reduction for those expected bad accounts when you don't know which ones will be uncollectible? Well, you create a contra account, an allowance for doubtful accounts, to remove them from that balance. Since we had not talked much about contra accounts before, I put this as number 4. Let's go now to number 3. I thought the 3rd most important thing in this chapter was that bad debts are recognized in the same period as the revenues that they have helped to generate. This is a wonderful example of the matching principle. You do not wait until an account proves to be uncollectible before you begin to report that amount. You anticipate that some will be bad, you estimate that amount, and you record that in the same period as the revenue. Now that does create some uncertainty. You do not know for sure how many will be uncollectible. You're merely having to make an estimation. One of the things that we have talked about in earlier chapters is the fact that financial statements have many estimations, and that really makes the financial reporting a challenge. Here's a good example. You make sales in year 1. You know that some will not prove to be collectible in year 2. How do you report that in year 1? The matching principle says you estimate it and you recognize them in year 1. I think that's an important accounting concept. I place that number 3. Let's go to number 2 now. I thought that the estimation of bad accounts was extremely important especially the fact that we have developed two ways to make that estimation: the percentage of sales method versus the percentage of receivables method. It's an estimation. There's often more than one way to make an estimation. Here we showed you two ways: percentage of sales and the percentage of receivables, and its variation, the aging method. Remember, in the percentage of sales method, I have referred to it in our earlier video as the add-in method. You take a percentage of sales, and whatever that figure is, you add it into bad debt expense, and you add it into the allowance for doubtful accounts. With the percentage of receivables method, I refer to that as the up to method. You take the appropriate percentage of the receivable balance and you bring the allowance account up to that balance. And it is that change, that amount that brings it up to the figure, that creates the expense. Two different ways to come up with an estimation. They do impact the financial reporting. For me, that was number 2. And finally, our number 1 thing of importance in Chapter 7. I love the idea that when you go look at financial statements, if you've had a course in financial accounting, you know what the terms mean and you know what the numbers mean. When you look at accounts receivable, the number that's being reported is the net realizable value. You probably didn't know that before you started this course, but you do now. And that's progress in gaining a knowledge of financial reporting. Net realizable value is an estimation of the amount of cash that can be collected. So when you look and see accounts receivable, it's not the total balance that you're seeing, but the company's estimation of how much they can collect. As we go through other accounts, you'll find that they have different meanings. To me, that's one of the very, very most important things about this entire course. What do each of these figures mean to decision makers? For accounts receivable, it means that it is the net realizable value, the amount of cash that they think they can collect. I thought Chapter 7 was very interesting as we begin to explore various accounts and how they're reported and what they mean. I hope you found this chapter to be very interesting. I hope your progress at school is going extremely well. Work hard, do well.